Hey, welcome to this week's video. Whether you're just starting out as a business owner or a more seasoned entrepreneur, tracking financial ratios can help you analyze your company's financial position and help you make more informed business decisions. Of course, there are dozens, if not hundreds, of potential financial ratios to track. So which ones are most important for your business? Well, in this video, I'll give you 10 financial ratios that you can start using today that I think will provide you with some of the essential ratios to look at and that'll help you analyze your financials like a pro. So let's get to work. Okay, so let's talk about why financial ratios. Basically, financial ratios go beyond the numbers to reveal how efficient your company is in various aspects of your company, such as its funding ability, making a profit, growing, and managing expenses. They can also provide a warning sign that things aren't going well, letting you know when to make a change before something bad happens. Also, these ratios are helpful to know as bankers and lenders often use them when evaluating your business and deciding on how much they can lend, if at all, to your business. As I mentioned earlier, there are a lot of financial ratios you can track, but most financial ratios fall into one of four broad categories. It's either going to be liquidity, leverage, profitability, and asset management. We'll look at 10 financial ratios across these four categories and provide you with what each ratio means and how it's calculated. Think of it like a gauge in your car. When a company has liquidity troubles, it may have trouble paying employees and suppliers and covering other operating expenses that could lead to big problems. So liquidity ratios typically compare the company's current assets, think cash, inventory, and receivables, with current liabilities. Your current ratio, also known as your working capital ratio, estimates your business's ability to pay your short-term liabilities and debts that are due within 1 year. Think like accounts payable and other debt that may be payable within 1 year from this point in time. The ratio is calculated by taking current assets divided by current liabilities. Current assets are those that you can easily convert into cash, such as cash itself, of course, inventory, and accounts receivable. Ideally, your current ratio should be greater than 1, meaning that you can settle every dollar of your payables and short-term debt with your existing current assets and still have money left over. Your quick ratio, which is also known as the asset test, is similar to the current ratio in that it's a gauge of your business's ability to pay its debt. However, the quick ratio looks at your most liquid assets, for example, cash, liquid securities, and accounts receivable, and excludes other current assets that are not as liquid, such as like inventory. So basically it looks at the assets that you could turn into cash easily within a short period of time and using those assets to pay off your current short-term debt and payables. Again, a ratio above 1 is good, but if below 1, it's not the end of the world, but you might want to focus on increasing this ratio and monitoring the trends. Next is the days working capital, which indicates the number of days required to convert your working capital into assets. Working capital is basically your current assets less your current liabilities and is used to measure your business's ability to invest money back into the business to generate more revenue. So a high days working capital number means that your company takes longer to realize cash from its working capital, while a lower days working capital can indicate that the business has less of a need for financing because they are more efficient with their working capital. Tracking your trends of your own business is very important. Okay, so now we'll talk about leverage ratios. Leverage is the amount of debt your company has in its capital structure. Capital structure means the debt and shareholders' equity of the business. Leverage ratios can also be used to see how much additional debt a business could take on. Thus, bankers and lenders will use this ratio. The first is debt to equity. Your debt to equity ratio compares total debt to total equity to measure the riskiness of the company's financial structure. Basically, it measures how much skin in the game the business owner has in the business compared to the debt the business has taken on. You see, lenders and other creditors closely monitor this ratio as they like to see that they are not the only ones with risk in the business. Also, this ratio can provide an early warning sign when companies are taking on too much debt and may have trouble meeting and paying those obligations. It's calculated by taking long-term debt plus short-term debt divided by the shareholders' equity, which basically is a sum of the owner's investment in the business and the retained earnings in the business. A good debt-to-equity ratio varies by industry, but a ratio of around 2 to 2.5 is generally considered good for most companies. That means for every dollar shareholders invest in the company, about 66 cents comes from debt, while the other 33 cents comes from equity. This is another ratio that lenders watch closely and one that you should follow the trends as well. Next is debt to total assets. The debt to total assets ratio measures the percentage of your company's assets that are financed by creditors. It's calculated by taking the total debt divided by the total assets of the business. Businesses with a high debt to total asset ratio could be considered risky because the company has to pay out a higher percentage of its profits in debt payments than a similar sized company with a lower ratio. Obviously, a good debt to equity ratio would be a ratio of less than 1. Profitability ratios are simple. They are ratios that look at a company's ability to generate income and create value for its owners. Think of it like a return on investment. If you invested in Apple stock, how much am I going to gain in that stock over the future in terms of the investment results? The first one is profit margin. The net profit margin ratio measures the amount of net income earned with each dollar of sales generated by the company. In other words, it shows a percentage of sales that is left over after paying all the business's expenses. It's calculated by taking net income of the business divided by net sales. You should monitor the trends of this ratio. I also like to use this ratio to see if the company has the ability to hire additional employees or not. I'll link to a video that I did on this as well. Return on assets calculates how well your company is performing by comparing your profits to the capital you have invested in assets. The higher the return on assets, the more efficiently you're using the resources of your business. It's calculated by taking net income divided by average total assets. It is more helpful to look at this ratio over time. For example, if this ratio rises from year to year, it generally indicates that you're getting more profits out of each dollar of assets on the balance sheet. However, if your return on assets is declining, it could mean that something is wrong. Next is return on equity, which measures your company's ability to generate profits from your investment in the business. It's calculated by taking net income divided by shareholders' equity. And remember, shareholders' equity is your investment in the business plus the retained earnings that your company has incurred since the beginning of your business. Think of this ratio like investing in a stock, which I mentioned earlier. If you invest in a stock, you expect to receive a return on that investment. This is what return on equity is measuring. A good return on equity depends on your industry, but similar to return on assets, you should track this over time to spot any potential issues. Asset management ratios analyze how efficiently a company uses its assets to generate sales. These ratios are normally only used by businesses that carry inventory or sell to customers in which they grant credit. These ratios are normally only used by businesses that carry inventory or sell to customers in which they grant a time period for them to pay. The first one is your inventory turnover. The inventory turnover ratio measures how fast your inventory sells and is converted into cash. And it's also used to measure how many days it will take to sell the inventory you have on hand at any point in time. It's calculated by taking cost of goods sold divided by average inventory. When evaluating your inventory turnover ratio, you should ultimately monitor the trends of this ratio to spot any potential issues in your business. A lower trending inventory turnover ratio can indicate that your sales are poor or you're carrying too much inventory. Next is receivables turnover. This measures how quickly you collect and turn your customer invoices into cash. It's calculated by taking your net annual credit sales divided by your accounts receivable. Basically, you want to have a receivable turnover in line with the credit terms that you offer to your customer. For example, if your credit terms allow customers to pay invoices within 30 calendar days, but your receivable turnover shows that you're averaging 45 days to collect payments, you may have a problem that you want to take a look at to get that ratio more in line with the terms that you're offering to your customers. So some key takeaways? Well, really there are hundreds of different ratios you can measure in your business. But these financial ratios we discussed in this video are a good start that you can use in your business to quickly evaluate your company's profitability and performance. Also, it works best if you track these ratios over time, as you can spot risks before they become problems by reviewing these trends. Of course, it all starts with solid bookkeeping, which we can help you with. In fact, we've helped clients create financial dashboards so they can review their results much like you review the dashboard of your car to spot any issues and see at a glance how everything is going. Well, that's it for this week's video. If you got any value out of the video, it'd be awesome if you hit that thumbs up. And if you're not a subscriber, it'd be great to have you as a subscriber. Until next time, I'll catch you on the next one.